If you're in any way involved in real estate, you've probably heard people or talk about, or you've even thought about seller financing, seller carry, owner carry. What does it mean? Should I use it as an alternate form of financing for my real estate deal? So I'm going to talk a little bit about commercial on the commercial side, what exactly seller carry or owner financing is and how it works, or some of the different potential options. Just a brief summary, because we do get a lot of questions about this. And how can I structure this? How can I set it up? So let me share my screen to go over just some of the basics. All right, so seller financing, sometimes referred to as seller carry or owner carry. And again, today I'm talking mostly about commercial real estate, but it can apply to residential as well. Essentially, where the owner of the property that's selling it finances some or all of the transaction. So the traditional lender that would come in, let's say you'd put 20% down in cash, 80% loan, and a traditional lender, you wouldn't have a need for seller financing. But when banks aren't lending quite as easily or rates are really high, people look for alternatives of maybe the seller can cover some of the potential purchase price. And this actually works. Seller financing is used in M&A transactions as well. It's used in a lot of alternative financing. How can it be structured? The most common way is, think of it just like the seller becomes a traditional lender. They're like your mortgage bank. So they're going to have a promissory note issued where, instead of paying a traditional bank, whether it's a Fannie or Freddie or through some type of lender, you're paying the seller instead of a traditional bank. And also, there's a promissory note and typically some type of a security agreement, whether it's a mortgage or a deed of trust against the property, that helps secure the seller that they're actually going to get paid, because title does transfer to the buyer. So the seller wants to make sure they get paid just like any other typical lender. So it looks a lot like a traditional lending deal. Preferred equity. They can be structured as preferred equity, which I'm going to go over in a little bit more detail on some slides, and also as a pledge in an entity. I'll also discuss this on the slides to give a little bit of an example. So this shows a seller carry basically as a note. So you've got essentially the property up here. The buyer comes in and takes title to the property. There's a promissory note issued saying that the buyer has to pay the seller a certain amount of money. And then there's a mortgage or deed of trust that's recorded as collateral against the property. So buyer doesn't pay, seller can execute on the mortgage or deed of trust, take the property back. So that helps protect the seller. Then once you've paid the note off, then the deed of trust or mortgage goes away and the buyer owns the property, just like a traditional loan. Typically in a seller carry, those notes are a lot shorter term. You don't normally see a 30-year fixed rate type of seller carry. It's usually maybe 2, 3, 4, 5, 7 years at the most in most deals that I've seen. Now, as a pledge, what does that mean exactly? So basically, the property is put into some type of a legal entity like an LLC. The property LLC owns title to the property itself. So it owns the property. The buyer initially owns the property LLC. So effectively, the buyer ends up owning the property. However, the seller has a pledge with a promissory note. And so that if the seller is not paid on the promissory note, the seller can basically take over, and in place of buyer, the seller would then own the property LLC. It's very similar to the prior slide as the note, essentially just adding another layer in where there's an LLC, and instead of a deed of trust that gets recorded against the property, there's a pledge agreement that says that the seller can take over the LLC if there's a default in payment on the note. And the main difference is there's no recorded deed of trust or mortgage. In this example, it's just a private pledge agreement between the seller and the LLC. That could be done for a number of reasons. They don't want a recorded deed of trust on the property, a number of different reasons, but that's just an alternative way of doing almost exactly the same thing. Now, preferred equity, this starts getting a little bit more complicated, but it can be structured as preferred equity, where essentially you have the property still up here on the top. It becomes purchased or owned by an LLC, or typically it's an LLC. The buyer and the seller are essentially owners of this LLC. So the buyer is part owner of the LLC. The seller is part owner of the LLC. The seller gets paid out as a preferred equity partner in that LLC. So they might get an 8% or 10% preferred return, which is just the same like a normal promissory note payment paid every month. And then when there's, maybe it's principal and interest until they're paid off in full, just like they would be in a note. So it's $1 million plus 8% a year. Once they're paid that full amount back as a preferred equity partner under the terms of the operating agreement for the LLC, then they've been paid out completely and they are no longer owners of the LLC. The buyer owns the property LLC 100%. The seller is no longer an owner and they've been paid out in full. So that's structuring it as preferred equity. So there's technically not a loan or a note. So there's different tax issues that come up when you're structuring it that way, because the payments are being made as a preferred equity holder of an LLC versus a promissory note like a loan payment. So it can be a little bit different tax-wise and for some other reasons. But those are kind of the most common ways to structure it. So the note, preferred equity, or a pledge, they're very similar. The payments are almost the same, and there's different ways of protecting the seller in all of them so that their interest is protected. But these are just alternative ways of financing deals that can get even way more complicated than this, but this is just a basic summary. So thanks for watching.